There you go. All right. So there's two things that I forgot to do last conference call. One was to unmute myself. So after like 10 minutes of speaking, I realized that why people were walking by my office, which is because no one could hear me. I had a great intro, but no one heard about it. So this time I've been told numerous times to make sure I unmute, and I wrote myself a note to unmute myself. So we should be live in action here. Okay, so like I said, help yourself study food. What we're talking about today is what we call our Smarter You series is that we have. We started these last year. So the Smarter You is just a little bit more in depth into specific topics. And like I said, we started it last year on just Medicare planning. And we were doing those kind of like on a quarterly basis. We didn't intend to do them really on a quarterly basis, but we had really good attendance, so then we continued to do them. And after it looked like it was pretty successful, we started to branch it off into other subject matters. So this is our fourth one we've done this year so far, been Medicare. We talked about for small businesses, behavioral finance. It will be more and more, especially as those starts getting axed out of the school system. So we're having a topic just specifically on that. But I put up here on the screen, you can see our calendar of events if you haven't already seen those. What we typically try to do is one of three different things. Usually we'll have educational events. We're really big on educating not just our clients, but also ourselves. So we'll have different educational events. We also will do community events. Like last Friday, we were just at the Horizons Golf tournament as a sponsor there. And then we also do just plain fun events. Like at the end of this month, we'll do our Pride Party. So if you guys are coming to that, it should be a lot of fun. But we figured by one of those three, education, community, or just fun, our clients will come to one of those three. So I hope at least they come to one of those three different items over there. So keep a pretty filled calendar of those different events. Go over here. Skip over here. All right. Oops. Got a little too fast. All right, so like I said, we're going to talk about the equity compensation today. My hope is to keep it, for Aubrey and I, we hope to keep it very high level in terms of kind of going into like the equity compensation side. We will dig into this more minutia and detail sides in terms of like restricted stock or non-quals, like the whole alphabet soup that goes along with it, and then the taxation. But along the way, I keep hoping to pull it back, and so that we keep a good eye on the big picture and not get so much caught in the weeds. The weeds are obviously very, very important, but the bigger picture is the more important aspect that we have. Like I mentioned a little bit, I want to introduce Aubrey. Like I mentioned, Brio's really big on just education. So every Wednesday, just internally as a team, we'll have an educational session, and we'll either do it like an internal speaker or an external speaker. She's come by and helped to explain different tax items. I included in here just a very, very brief bit on her bio. I included her link because it was very long, but I think at the heart of it, I think what you'll get as you hear her talk is one, extremely knowledgeable, and then also just extremely giving with her time. So I'm really happy that you're here to help break down this complicated matter and simplify it for us all over here. We'll just be kind of going back and forth and talking, but like I said, my whole hope in this is to keep it very informal. I would like you guys to just jump in whenever you guys have questions, or we're talking too fast, or if we're going too much in the weeds. By all, like I said, by all means, we're here for you guys here. I also just have to state that it's being recorded. We record it because some people can't dial in during this time period, but they want to get the notes and like the information. So like any past events that we've done, we've been recording them as well, and they're on our website. So like I said, those other ones that I've mentioned, you'll see them there. And then from our compliance end, I always have to state that the information that we're going to be talking about today is general information. Any personal personal information, please make sure you consult your tax accountant and your financial planner. And if you don't have one, we'll be glad to talk to you on those different matters over there. So that's my compliance plug for the afternoon. And then with that, let's just dig in. I'm not sure, Aubrey, if you want to mention anything before we kind of get started in here.
No, yeah, I'm just going to I think we're just going to kind of jump in. You know, hopefully between the financial planning side and the tax side, we're going to give you guys a good kind of high level comprehensive on equity comp. So yeah.
Yeah, and so you'll see over here, like in terms of like the alphabet soup, right? In terms of like ISOs and non-quals, I was just actually talking with a prospective client this morning, and just had a lot of confusion in terms of what her equity compensation was, or you know, what should she do with it, et cetera. And I think like the whole, you know, as we hopefully, like I said, as we're talking about this, what you'll see is that when we break it down to smaller pieces, it's hopefully not as complicated as it seems. There's just a lot of terminology that's out there, or a lot of like buzzwords that are thrown around. So what we're hoping to do is, again, make it more specific, and kind of tie it into how it impacts you. And the first part that I'll start off with is just in terms of like, how do we, when someone has equity compensation, or they go through what we call a liquidity event, like what do we do? Like what is our plan in place? And before I go into like what we do, like the first part is just understanding like what is a liquidity event. I think is to kind of take a step back. And so I just like, as a simple example is like Uber, right? That just had what we call a liquidity event. So Uber's liquidity event was what they call an IPO, or initial public offering, that just happened. So now in hindsight, I mean, Uber's getting a lot of press, or they did get a lot of press leading up to it, and things like that. And it can seem very straightforward in terms of what to do with that equity compensation. But if we go back essentially 10 years when Uber first began, back in 2009, when they were handing out ISOs, or incentive stock options, or non-qualified stock options, people there didn't really essentially know, like it was difficult to know what to do with those. So with the liquidity event, as a simple example, let's say I worked at Uber in 2009. Uber decided to give me 100,000 shares worth of Uber stock. They would do it for one of two reasons. One was they didn't really know what the company was valued at the time, and then two, because again, it was an infant stage, and then two, equity compensation is a form of retaining staff, right? So one of those two reasons is typically why they hand out a lot. So they might not have been able to pay as much, or they were just, again, trying to use it as an attractive tool to take other talent from different technology companies to work with them. So again, kind of staying on that simple concept, 100,000 shares, and they granted it to me for $1. That was the option. So again, that seems pretty straightforward. I got 100,000 shares, and I have an option to buy it at $1. At that time, I can make a choice. I can decide, hey, I want to, what does that mean? At that point, it just simply means it is a piece of paper, right? I have the option, which means I have the choice to accept, I can pay for those and keep those as owning them, or I can just leave them alone, and it is just paper money at that time. To make that a little bit more complicated, Uber at that time was a private company. So even if I decided to pay $1 for those shares, the second question is, like, if I wanted to sell those, who would I sell those to in the future? And $1 doesn't sound like very much, right? But when you have 100,000 shares, like 100,000 times $1 is $100,000. And if I'm going to purchase that, that is a lot of money. So I have to ask myself in terms of like, do I have that cash to purchase it? Who will I sell it to? There's going to be tax ramifications that are associated with it. And ultimately the question is, or why people were buying those, or if they did buy those, was there's a thought that Uber is going to be a great company, and 10 years from now, that share will be worth $45, right? So there's a $44 gain that could have occurred during that time period. Again, in hindsight, it's really easy to say like, oh man, I should have bought that for $1 a share, and what the benefit would have been. But at that time in 2009, right, medallions or taxi cabs were running the streets at that time, and Uber was not a verb like it is at this point over here, right? So again, from that simple concept is, so these employees, right, get shares or have received shares. You might receive those shares, and they so each year they're getting a different amount. And like I said, typically in the onset part, or why I use private companies is typically private companies will give out a lot of shares at the onset for two reasons: to attract people to work with them to start off with, and the second, they don't really know that true value yet because again, they don't really have a value at that point. So fast forward to when it does have a liquidity event, there's one of three ways it can become liquid. It can become liquid because they have a private buyer that now has said, hey, that $1 share of Uber, I would like to buy that off of you. They could also be internally purchased where Uber might not have enough money and say, hey, you know what, Philip, I gave you those shares. I would like those back, please. And I will pay X amount of dollars for those. Or it can do the third option, which is listing itself as public, or that initial public offering, which then it is then open to the mass public to buy in at that point. And again, kind of sticking on that Uber side, again, that is a real example where there is now a, when it went IPO, it was now worth $45, and there is a $44 gain inside there. So again, $44 now times 100,000, that turned out to be a chunk of change. Sorry, any question?
No, I'll let you finish.
Oh, no. So now, as I say, now we get to this actual slide over here, which is like, now what do we do, right? So I always say, like, the first part, there's a little bit of celebration that occurs. Typically, there's like a run-up time of when, you'll get like a notification of when it's going to happen and things like that. So I always say, like, congratulatories, etc. Get excited. It's obviously an exciting moment. But then I want to take a step back, and I want to make sure that we don't get too far ahead of ourselves, right? So let's not forget our financial planning principles. So prior to the Uber liquidity event, maybe I had $200,000 in my investment accounts. Now I will have like 4 million in my investment account. So that's a huge difference, right? But I want to make sure that I don't go crazy along the way, because there's going to be tax ramifications that are going to be involved. There's going to be liquidity. There's different rules. Like Uber right now is stuck in their like after it goes IPO, it is stuck in its lockup period. So there's still a period of time. So main thing is, again, just like anything, whether you had $200,000 or 4 million, or whether you have $400,000 or $4 million, we're still going to do the same type of planning, where I want to take care of, like, your cash flow, your balance sheet, your insurances, your taxes, your estate planning, right? The goals might change because I'm going to have more liquidation, but I know if you're okay at 400,000, you're going to be okay at 4.4 million. So kind of that behavioral finance part, where I want to make sure you have good habits before you start receiving that big chunk of change. Because if we don't have those good habits, or we don't have those in place we don't have that in place, then that 4.4 will very quickly go back down, what they call kind of that lottery syndrome, right? Where after 3 years, after a lottery winner wins, like, they don't have that money anymore because it got cut in taxes, and then it got cut by, like, long lost relatives, et cetera. So we want to make sure we have good fundamentals in place. Like I said, we'll talk about your risk tolerance, your investment considerations, like concentration of stock, and then like the tax consideration sides. So we'll go into those different topics. But again, but that would be the same planning concept that would have with someone without equity compensation. I have the same one. With equity compensation, there's just different wrinkles, because again, it's very personalized, and what you might have is very different than your coworker might have, even though you might have started 2 months differently. So I have to understand what you're looking to do. So we go into that part.
And I just want to mention too, like IPOs are obviously the ones that people know about the most, but the other liquidity events are much more common. They happen more regularly, I would say. And the other thing to think about is that there's limited control, right? As the person who has the equity comp, you can decide if you're going to exercise your options at any point from the time you have them until much later at the liquidity event or later. But there's, sometimes it's, well, we're merging with this company, and now the options that you have are turning into this, and this is what you're going to have moving forward. Like there's limited control sometimes that can also impact things that I think. Anyway, I just think that's something to keep in mind, is that it's not all within your own power all the time.
Yeah. And then sometimes, like the liquidity events that I was using, the private company, you'll see a bigger pop that occurs there, right? So like people who work at Apple, it's an established company, they get, restricted stock and stock options, or if you work at Google, you get, Google stock units. But you just won't see as big of a pop between what they granted it for versus what they get, mainly because it's a public company. So that price is already embedded in, and so they know what that fair market value price is at that time. So sorry, you wanted,
Well, I was gonna say, even, isn't there occasionally, even with the stock options, sometimes there's restrictions on when you can buy and how you can buy, and
Absolutely.
if you haven't exercised that options, it's still out paper money.
Right.
Right.
Yeah.
And how, and so there's always blackout periods for various reasons, right? For valuation reasons, for, for transactions, all kinds of things. So it's not like now that you have it, you can just at any moment choose to do something. Like for the most part you can, but there's always going to be certain periods of time where you're stuck. And so usually that in advance, but then you could, sometimes, for example, I have a client this week who she's going to have a lockout period tomorrow on some incentive stock options that they're going to redo their valuation. It's a private company. So she had to decide this week, are you going to hurry and exercise? Because they expect the valuation to come in higher, which means her spread will be higher, which we'll talk about in a second. So she needed to hurry and decide, but they told her on Monday, your lockout's going to start Friday. So decide.
Yeah.
Exactly.
Yeah. So that's, again, kind of what we look at, the tax considerations, and then what type of equity do you have and the different restrictions that come along with it. On this here. All right. Okay. So I just put on here just the most common types of equity compensation that are out there. Stock options are typically the most common ones. Incentive stock options or non-qualified stock options. And we'll break into that, what those mean. Then there's restricted stock units. And then I just put on here employee stock purchase plans, or the ESPP. And that is not kind of like a truer equity compensation supplier, but it is an incentive of what companies do to kind of keep and retain employees, and I think it is a great benefit. So I included it in here. There's other items that are out there as well, restricted stock appreciations or RSAs or stock appreciation rights. So they all will kind of have, like what we'll talk about is in the terms and concepts, they're all are going to have a very similar like concept, like when are they granted to you, and like when can you purchase them, and when do they expire. So I think like what we're going to talk about, we'll kind of go into the different terminology. But from a very high level, like if we want to look at stock options, or when I think about stock options, like I'll compare those a little bit to like a lottery ticket, right? They give you a lot of them. They may be worth something. They might be worth like $1. They might be worth $1 million. We don't really know, right? And they give you a lot of them because the company doesn't know either. So you can kind of think of it as a lottery ticket. So I won't necessarily like take value in it unless it's a public company. Then we can start considering it, but not until we hit those specific dates will we actually start considering it. So I don't want to plan for like, before it's hatched yet. I want to see it hatch. But again, I want to understand what might occur if it does hatch, but I don't want to live your life that way just yet. But stock options, you can think of it like lottery tickets. Restricted stock units, you can think of it like as a bonus. They tell you they're going to give you 100,000 shares. You will get 100,000 shares. What that might be worth, I don't know. It might be worth $40. It might be worth $20. But get 100,000, you're going to see that a year later, or a portion of it, right? So restricted stock units, you can think of as bonuses because because they will give it to you. They typically will give you less than they would for like an option, right? Yeah, go ahead.
How common are these equity-based compensations? I don't remember ever having one. I guess I'm unlucky.
Yeah.
They're very common in Silicon Valley. Very common.
Oh, okay.
Yeah. All tech companies do.
So-
all the tech companies have.
So
yes.
I work for a public university.
Yeah. Unfortunately, then no.
I haven't gotten
Yeah.
Well,
All the.
But on the other hand, I worked for PG&E and we had retirement, we had a whole different set of benefits.
But some even, like Wells Fargo has.
Yeah,
equity comp that
a few of
that
my
their
friends got
employees get, yeah.
stock, but I was never the right job.
But it just depends on but all the tech companies, every tech company pretty much that I can think of has some version of this, including options are much more common in like the start when they're brand new. Then it's more common. Restricted stock units. Google has their own GSU, which is a Google stock unit. They all, Apple, Salesforce, all those guys, they have. I think that's more common in kind of a more established company. Yeah.
Yeah, and then I mean, for like in terms of like how common, like you can kind of think of it like a 401k plan, right? Like that before that used to be a little bit of a novel concept, and now it's like to be competitive, you have to offer it, right? So the tech companies, if they want to attract, this person to program like across the street, they like stream video games for other people to watch them online in order to get that job or to attract that talent. They offer equity compensation. So you can kind of think of it along those lines. ESPP, or the Employee Stock Purchase Plan, you can kind of think of it like savings on steroids, right? Where, like, again, there's different rules that are involved, but you can think of it like, hey, I'm putting money into this. After 6 months, I will get a discounted price for it, and typically got a 15% discount. So if I sell it right away, it is like after tax, like right around like a 7.5% rate of return during that small time period there. So again, there's rules that are involved with it. So and some have different holdout periods, but just from a very general standpoint, stock options, lottery ticket equivalent, RSUs, bonus and ESPP like savings on steroids. So that's how I'd like to think of it.
Used for retention, or at least that's what we were given to believe, is to hold on to us, is to offer us incentives. Extra incentives over and above what the others.
Yeah, definitely as a retention tool to keep them there. Because what we'll go into next is going to be like your vesting periods and things like that, right? So hey, I gave you 100,000 shares of Facebook. That sounds great. However, in order to receive it, you have to be here. I'll give you 25% year 1. I'll give you the next 25% year 2. That's what's known as your vesting period, right? I'll give you the next 25% after year 3, et cetera, and stretch it out over those periods of time. So yeah, they definitely are using it as a retention tool in order to keep you there. So again, let's go into some of this different terminology that we have. So from like an incentive stock, for like an incentive stock or an option or restricted stock, these are going to have the similar verbiage. But grant date is just simply means like, when did I receive that? When was that given to me? So I started working there May 1st. On June 1st, they granted me 100,000 shares. Vesting date means when can I have access to that? And how much will I have access to? Exercise date means when did I decide to purchase that side. And then expiration date is going to be if I have not touched it at all, then when will that expire? Or in like that call that I had this morning, the person was leaving their job and they hadn't exercised their options, and so they have 90 days to exercise their options before they expire. Exercise just simply means, again, kind of back to that Uber example, they gave me 100,000 shares for $1. I have the option to purchase that or not purchase that. When we get close to the expiration date, I have to make a decision by that time period. I have to decide, yes, I will pay $100,000 for those shares, or 50,000, whatever the price might be, or it will expire, and I will not have that choice anymore.
Right. So exercise date and expiration date are more option related, because like best for like restricted stock units, right? Best date is the date they're giving them to you. Like it's no action on your part is required. They're going to vest, and you're going to get them on that
They're
day.
actually giving you stock. They're not giving you a
Right.
purchase
They're not giving
option.
you an option to buy. They're giving you actual
the actual
shares. Right. But exercise date is relevant to your options in that you are going to decide at some point whether you're going to take action. And so that if you do take action, that's your exercise date. And then it's super common. I've run across very few options, more or less 90 days after you leave, they're done. So that's often when, for a company that hasn't had some kind of big liquidity event, it's when people are moving on to something else and they're trying to decide, how much do I believe in this company, and should I spend some money to exercise to own some shares or not?
Good. Other questions? And then the price part over here, strike or exercise price. So again, these are going to be option related side, but a strike price just means, so in that Uber example, my strike price was $1. Right, so I have to pay $1 in order to obtain that, and we'll talk about how to do that. But you'll have to put, that's your exercise price or your strike price. Then there is what's called a fair market value at exercise price, and that just means like, okay, I had to buy it for now, like 5 years went by and Uber was worth, let's say, $20 a share, and I decided to purchase it at that time period. So my exercise or my strike price was $1. That's how much I had to pay to get those shares. And then when I exercised it, it was the fair market value at the time was $20. So there's a $19 spread over here. So there's going to be tax ramifications that are going to be associated with it. I do not have to sell it if it's an ISO. I do not have to sell it at that time. That's the last part. When did I actually sell it? And again, there's going to be a slide that shows like these 3 different things over here. But just mainly to know that there's a strike price or the fair market value when I decided to purchase it, and then when did I finally sell it. Sometimes they can happen, those last 2, the fair market value and exercise and sales price, can happen simultaneously, but theoretically they can occur at different times. Yeah. Okay, and then again, kind of other buzzwords that you hear. Again, I'm just trying to lay out like the buzzwords that you'll commonly hear out there. Cashless exercise. So cashless exercise means, like I've been saying for Uber, right? I have to come up with 100. This is a private company. Usually this would be the case. I want to purchase those 100,000 shares at $1. I will have to come up with that money typically because there's no market of who else is buying that. In a public company, let's say it's Apple as an example, and I have options. I can do what's called a cashless exercise, which means that I am purchasing. There's a spread difference, right? There's like my strike price is, $100 and the price is really worth $150. I can use my Apple shares in order to purchase those directly, which is called a cashless exercise. So what's technically happening is I am selling my shares of Apple in order to purchase that first section over here. And then I can decide in terms of like what this little difference is and what I do there. So it was a little bit, I don't think I made that the clearest example over here, but I'll show that in the slide that's coming up in terms of like, just know that in that example in a public company, I don't have to come out with money out of my own pockets. I can use the company shares in order to purchase those directly because they will have a monetary value that's there. Bargain element, I'll show. I think that'll be a little bit clearer, but the bargain element just simply means like the spread difference between what was the strike price versus the fair market value. In the money just means that in that simple example of $1 a share of Uber and it's worth $45, there's $44 that's in the money or that is worth something. Out of the money means that it's gone the opposite way, right? It was worth $1. That's what I have to pay for it. And the company is worth 75 cents. That's what the fair market, that's what someone would be willing to pay for it. That would be called out of the money or underwater. And in that instance, that's kind of when I started, was right after the .com crash. And I know no one thinks that their company this will not happen to their company, but during that time period, a lot of people had exercised to try and take advantage of some of the preferential tax treatment, and then their companies went down in value, and now they were underwater, and so like no one was really willing to purchase it back at that time period. So anyways, so the stock can theoretically go. I know it's hard to imagine, but stocks can go down in tech companies that you might work for, or whatever your company is that you might work for.
So that's like what?
So like Lyft.
This price and their valuation now is what, about 25%, 30%?
So, and that example of like Lyft would be like, so some of those people, like if I started working at Lyft, like when it went IPO, then they probably gave me shares like right at like, let's say $60. And now it went down to like $50. So yes, in that instance, if I just got those shares, then yes, I would be, if I had like options, I would be underwater. A lot of the other people had been working there for several years. So they probably got those shares really at like, $10 or $15. So they are actually in the money. It has gone down since the IPO, but they are theoretically in the money with their option price. So again, it depends on, that's what I was saying, it depends like what your start date is. Because you might be in the money or you might be out of the money. And so it depends on what your strike price is during that time. All right. Okay. I'll leave these terms and concepts to Aubrey here.
Oh yeah, and I doubled up, I realized. So qualifying disposition, this is related specifically to ISOs. And when we kind of get into the tax meat of incentive stock options, there's such a thing as a qualifying disposition versus a disqualifying disposition, and it impacts the tax treatment. An 83B is an election that you can make on restricted stock, not restricted stock units, restricted stock. And it's we'll go into the details of that as well, but it's a tax concept. It's an election you make with the IRS that impacts the tax treatment of 83B. AMT, which is alternative minimum tax, which is a huge issue with incentive stock options. And then spread or bargain element, which was actually on the other issue, on the other slide. So that your spread or your bargain element has a big impact on your tax kind of implications in every one of these scenarios. But in particular in ISOs, for AMT purposes, it becomes a big consideration.
Okay, so this is kind of like as simplified as I can get from like an incentive stock option side over here to kind of illustrate like what it looks like. But over here, you can just kind of simply see that I got a grant date of March 1st, 2015, and they said that that price at that time was $20 a share over here. Fast forward 3 years later, the stock price was then worth $50, and I decided to exercise that at that time. It had a gain of roughly, from 20 to 50. Over here, it had a gain of $30, or what's known as that bargain element. As Aubrey just mentioned, you can see it's a preference item. It's an AMT preference income item. So I might not have sold it during that time. I just exercised it. I decided to keep it. I do not actually own it yet because that would mean I would have to sold it. So I don't actually have any money at that time period. However, it is taxable to me at that time. So that's what that bargain element is, where it is that preference income item for AMT. Fast forward 2 years after that, I did decide to sell it. The reason why someone would do that, exercise and hold, is they are now looking to get what's called a long-term capital gain because they've held it for longer than a year after their exercise. So now instead of being taxed, so instead of selling it at this time period here where they exercise and sell right away, where they would now be subject to ordinary income or short-term capital gains, they've held it for a long enough time period where their spread difference is now considered long-term capital gains, which lowers the tax consequence. Do you want to touch upon this?
Yeah, so I do. So just a few kind of key things to consider here. So ISOs are one of those things where there's more considerations, I think, for you as the individual to think about what you're going to do and what it's going to mean for you, because there's more kind of decisions to be made, I think, versus some of the other stuff. It is what it is. You take it or leave it. So here you have to pay. So when we exercise, right, we have to pay our $20, and that's $20 out of pocket. So you got to have that $20, which isn't a big deal, but sometimes it can be $20,000, right? So it can be a big number. So you need to have the cash for that. Second of all, so we have our bargain element, which is an AMT adjustment on your tax return, which means that on that bargain, you may or you may not pay AMT on that amount. And whether you're going to pay AMT on that amount depends on everything else on your tax return. And there is no like, just, back of the envelope, yeah, if you're within this range, you're going to pay it. But that AMT is, it's a mess, even if you are a tax expert. AMT is a mess. So you have, essentially, you're going to need to either just know you're going to pay it, or you need to understand if you're going to pay it. But exercising ISOs and holding on to them, this is always an issue, because the thing is if you are going to pay AMT, keep in mind that that's going to be another time when cash is going to have to come out of your pocket. And like if you're at a private company and you can't sell those shares, right? You've exercised and now you have a bunch of shares, but they're not liquid. You've got to have all that cash. That's got to have a pot of cash you have sitting somewhere else. So you need to be able to pay to exercise, and you need to be able to pay for your tax costs. And then you're holding, and the reason why you're typically buying them and then holding them is one, because you think the price is going to go up, and two is you're looking for long-term capital gains treatment. If you buy them and then you sell them immediately, for example, the company's willing to buy them, or there's some kind of a market where they're let you sell them immediately, then that bargain element becomes ordinary income instead of capital gain income. So it's more expensive from a tax perspective. Sometimes though, sometimes it's still worth just buying and selling your ISOs immediately, and there's various reasons to do that, from diversification perspective and from I want to get the cash and but I don't really have the cash to deal with tax consequences. Like I need to sell them in order to actually afford to do this. So you may do that because there's still value to be had. But this is kind of where ISOs can get dicey, is when I've actually had clients where I've had to negotiate with the IRS like payment plans for them because they exercised a bunch of ISOs. They didn't realize it was going to come with a huge tax bill, and now they can't pay the tax bill because they don't have the cash. So this can create a cash flow issue for people if they don't really understand what's going to happen to them if they hold.
So basically, when you exercise your stock option, that's considered, the differential is considered income for that year. You had an option, you left out, it actually was.
It's income for alternative minimum tax purposes only.
Okay. So
not for ordinary tax purposes. Right. So it may, or that's why I'm saying it may come with tax consequences and may not come with tax consequences. So just this week, I was telling you there's this blackout period for a client for tomorrow. She's got a bunch of ISOs. So she called me and said she makes a lot of money. So she often is, there's kind of this window where you pay AMT. You're either below it and you can get above it, and then there's this window in which you're in AMT, and she's above it generally. So she called and said, how many ISOs can I exercise before I'm going to pay AMT? Yeah, so we're running scenarios to figure out exactly where she's going to be, and so we've decided how many options can she exercise where we know she's not going to have to pay anything, right? So it is possible you don't pay anything. It's also possible it could be very expensive. So, and it's not, unfortunately, it's not as easy, like I said, as being like, if you're in this range, you're going to pay, and if you're in this range, you're not. That's just unfortunately not that simple. So
yeah, and I think two important points that Aubrey made is that one, the reason why you're exercising and holding it is because you think the stock price is going to go up, so from a long-term capital gain. And like I was just mentioning, you have to hold it for at least a year. Theoretically, it could go down, and it has gone down for some people. So now I may have paid more taxes than I thought I should pay, and the price might not stop at 20. And so this is what happened during those .com days, right? They went out of business, so those stock were then worth nothing. So now I just paid my AMT taxes, and my stock was worth nothing at that time. It took maybe 4 or 5 years before Congress made a rule that allowed them to get some of that AMT money back, but I think it was like a 6-year. So for 6 years, people hadn't paid, and they were like, I don't have money to pay these taxes over here, and the stock is worthless. So again, it is a risk tolerance question. So kind of taking a step back in terms of from the financial planning side and from the tax planning side, if I'm going to do this, I have to, as Aubrey's mentioned, I have to have cash set aside, one, to exercise it, 2, to have money potentially for that tax consequence. So prior to doing that, we'd want to know, like Aubrey's mentioned with this client, we would like her to do those different scenarios so we know what the possible tax consequences might look like. And then once I know that, do we have enough money to pay those during that time period? And then 3, do I have that risk? Do I have that risk tolerance threshold to wait for it to go up or to kind of sag around over here, right? So again, there's multiple steps. And for what? What am I doing it for? It's to essentially get like a discounted stock. I'm still going to owe taxes, right? When I sell it, it's just at a discounted rate. So what's the trade-off for taking this risk? I'm going to owe lower taxes. Well, how much lower taxes? Again, you'll see like the software tool that we'll use to look at that. So there's just a few different, there's a handful of different questions to look at before you do that. It is not a slam dunk. I have an ISO. Yes, I'm gonna exercise it and just sit and watch that, little sucker right up. Whereas there's other things that are involved. And so again, I think that's what Aubrey is extremely helpful in, is running those scenarios to help to consider that. Questions on that?
Just a quick question on the exercise date, March 31st. So let's say you decide to sell. And so the 30 goes towards AMT, but the full Well, I guess it goes as ordinary income. 30 turns into ordinary income?
Correct.
Okay.
Yeah.
Okay.
So if you, if you exercise and sell that same day, then that 30 is just gonna be ordinary income and you're just gonna pay tax on it and that's just done.
And there's no AMT or, I mean,
Right, right. There's no like specific AMT preference related to that item. There's no, obviously, you're no longer gonna hold the stock, so you're not waiting to see if it might go up or down, like kind of all the risks just happen. You got this extra 30, it's in your income now, you're paying ordinary income rate on it, just like your wages, and that's just said and done.
Okay.
Yeah, and that's a disqualifying disposition.
Way to tie it back together.
That's it, yeah. So when you don't hold it, don't hold the option for a year and then hold it for at least a year after exercise, that's called a disqualifying disposition. A qualifying disposition is when you do what is shown here, yeah.
And then I think along the way with the incentive stock option, I'm not mistaken, you can talk about like payroll taxes and things like that, if you did hold it as a qualifying disposition versus if you did not hold it as a qual.
So, well, with ISOs, they don't withhold. So
Yeah.
even if you, with ISOs, if you do a disqualifying disposition, meaning like you just sell them on the day it's ordinary income from the company perspective, the income is going to show up in your W-2, but they don't withhold taxes on it. They will withhold FICA, but they won't withhold like federal and state, which they will on non-quals, which we'll talk about in a minute. So the thing to always know if you exercise ISOs, even if you sell them immediately, is again, all that tax bill is gonna come for you. Like, right, you're gonna have to, granted you've sold them, so in theory you have a bunch more cash to handle that tax bill with, but it's all gonna come out of the money that you received. They're not withholding, versus with non-quals, they're gonna withhold. So like, some of it is cash that never kind of comes into your pocket. And so that's a little bit helpful for some people who have judgment issues. One thing I just want to mention, one other thing on here that I think sometimes people get confused about is, so keep in mind that your $20, right, that you paid for that stock, that's your basis when you're calculating your gain from a tax perspective. So even if you end up paying AMT here on this bargain element, you don't get basis for paying taxes, right? So when you calculate your gain over here, like if we follow this scenario, you have an $80 gain that you're going to pay tax on. So even if you've paid AMT back here, it doesn't mean that you're going to pay less. You're still going to have an $80 gain you're going to pay tax on. You may recoup some of that AMT through this credit process that he was saying government has put into place. But again, when you'll recoup that, and if you'll recoup that is not a guarantee. So it's kind of a risk thing.
All right, good, straightforward. You got it.
It's just a bad thing.
There's like a potential of almost being double taxed per se. Because one's AMT and one is actual
Right.
income.
Right, but there is a potential of paying a whole bunch of tax on an ISO. So that's why for a while, even companies kind of got away from ISOs, I think, because it kind of got messy here. The ISOs are back in full force. Like a lot of people have ISOs again,
So again, so I think some of it is kind of just understanding the terminology, right? So like, do I have, like, for an option, like question one, I'll ask like this morning was like, do you have an incentive stock option or non-qualified stock option? Because that'll make a difference in terms of what my choices are going to be. Because we have a non-qualified stock options, there's not too many choices that we need to make there. If it's incentive, that will be a little bit different. So again, just kind of start basic is like, what do I have, right? Because this instance, it was like, I'm not sure. And again, so some of those little terminologies some of those little nuances make a difference. And what I don't want is for people to kind of like stick their head in the sand because they don't understand like the terminology in here. Because there's a lot of buzzwords, but they all will kind of start sounding like, you know, they'll all be broken down into more manageable pieces, so we can figure out what the right steps are going to be here. Non-qualified stock option. I think the biggest difference over here is when I exercise it, instead of that AMT partial treat here, it will just be realized as ordinary income there. And then once I sell it, then that will then become my basis at that point. And then when I sell it, I will have capital gains afterwards on that side. But I'll let the expert
Mhm.
jump
So
into this more.
the big difference here, right, is that when you exercise, there's an automatic occurrence. It's ordinary income. It's going to go into your W-2. They're going to withhold taxes on it. And then you have a $50 basis, right? You have your 20 that you paid, 30 that you recognized as income, not as a like fictional AMT preference item, but actual income. And so now you have a $50 basis. So then when you sell later, so this is like your only choice really here is not like, look at all of my scenarios and will I pay tax and won't I pay tax and should I hold them or should I sell them? It's really like, are you going to buy them or are you not? And then all those consequences are just going to fall. Like that's just the result, right? It's not that you can kind of, so ISOs, there's more kind of options and planning, and then there's also more traps.
So this would be the case of like, I'm working for Apple and they like me and they gave me non-qualified stock options just to make me happy this year, or kind of as a bonus, as opposed to, we really want you to come work for this company that may or may not exist in a year. We'll give you lots more stock options as an incentive.
So usually
That kind of difference.
Apple's going to give you more like a restricted stock unit.
Okay.
So this is usually, options are usually companies earlier on who have more unclear value.
Okay.
So they're, and they may become very profitable and they might become worth a whole bunch of money. But usually like option exercise prices are cheap. They're usually $1 or less. Like they're very cheap, right? So we're going to give you 100,000. The client I was talking about, she actually works for an e-cigarette company, and she has a whole bunch of ISOs with exercise price of less than $1, and right now their valuation is $300 a share. So she has a almost $299 spread on each of those, which makes for a big AMT preference. But it's also, she got them back when this company when e-cigarettes were barely a thing, and they made them very cheap. But now it's been acquired twice and and it's become very, very valuable. So usually I think of options kind of come in earlier stage companies that don't have a lot of clear value. Whereas the RSUs, which is more like a bonus kind of thing, those are more Google, Apple, Facebook, Salesforce, those guys. Yeah.
All right. So now RSUs, right? So this bonus example side where there's a grant date, right? So, hey, I started on May 1st, 2019. That is my grant date. My vesting, and same thing, they gave me 100,000 shares. My vest date will be like they vest over a 4-year time period, 25% over each vesting period. So 1 year from now, I will own 25,000 shares. What that value is of those 25,000 shares, I don't know, right? Because the stock could have gone up, it could have gone down. However, whatever it is, I am subject to taxes at that point, just like a bonus. Hey, I got a bonus for $50,000. I am taxed right away, right, on that. So these 25,000 shares I received, I am taxed at that whatever that value is. The difference between a bonus and the RSU is I can hold that share if I would like to, right? So that Facebook stock, I would like to keep it. So those 25,000 shares, they've withheld taxes right away from those to pay it. So really I might have more like 20,000 shares. That's what probably showing up on my statement at that time. So those 20,000 shares is now serving as my cost basis. And I can decide to sell it or I can decide to hold onto it. And that at that point will be up to you to decide, or like, again, kind of like what's the risk tolerance? Like, do I need that cash? Do I believe in this company? Do I want to hold it or not? But whatever it is, so let's say that I have $20,000 and I sell it the next day at $19,000. I have a loss of 1,000, or if I sold it for a gain, I would have a gain in there. So, so the RSUs, the main part is that at the vesting date, those shares are going to be taxable. The tax will usually come out of the shares that I own, unless I've opted to pay it out of my own pocket. But typically, you won't see 25,000 shares. You'll typically 20,000 shares, and then after that, you can decide.
Right, so the company's required to withhold taxes, and in order to create the cash to do that withholding, they sell some of your shares. Unless you choose to do, unless you make some kind of election to do something else. And usually in this scenario, so this is often the more established companies. And, you know, they're often kind of the only choice you have here is, are you going to hold the shares once they vest, or are you going to sell them? And then are you going to stay through your whole vesting period? Right? And some companies vest once a year, some companies vest every quarter. Like, it all depends on your different grants and how much and what your vesting schedule is. And they're different depending on who you're working for. But that's and these are used hugely for retention. I mean, this is how they really get people to we have people, and I'm sure Abraham does as well, people all the time who are like, well, I'm going to wait until March because that's my next vest, and then I'm going to leave. I'm going to wait until this vesting time before I'm going to do something.
No, one of the things we haven't mentioned is, like, when you're thinking about selling either an option or one of these restricted stock units, does your job within the company have any influence on when you can do that? Like, if you're on the financial side and you know there's some insider trading aspects you need to consider when you're
internal independent. So always when you're an employee of a company, and of course where you are management level or otherwise, there are always often some periods of time in which you cannot sell. They're called blackout periods for insider trading reasons and etc. So there are always periods in which you may not be able to exercise your options, or in which you may not be able to sell your stock. So it's not like you just at any given moment can do it. And always when there's an IPO, for example, there's always a blackout period definitely for management and often for others, in which they can't do anything with their stock. So there are restrictions, yes.
Yeah, and then and in terms of, like, some people like feel a little bit of a loyalty or don't want to sell, right? So I have like some employees at PG&E and they really feel loyal to PG&E, and they're like, I don't want to sell the stock because it's going down. And I'm like,
yeah, PG&E's had that problem for years.
Yeah, so they those are not going to really show up. Like, the management team is not going to look at it and say, oh, like, you just sold that stock, like, you don't believe in the company, therefore, you don't believe in what the company's doing over here, like the loyalty wise. However, if you are on like the board or like a disposable area, if you sell, that will be published, right? You do have to report that. And sometimes when an insider, those are typically called insiders, when an insider sells, that can be looked upon as like, hey, you know something more than someone else, and you don't believe in the company, and therefore it can impact the price of the stock, right? So there are what is kind of called what sometimes referred to as like a 10b5-1 plan, where it is auto selling at specific time periods, so that it is getting you away from that. Some companies, if you're an insider, will have like, you need to own $400,000 worth of the stock at all times to show how much you believe in the company. If you're an insider, typically you have to call a legal, you have to get clearance from legal before you make a sale to make sure that you did not have any insider information. So again, like Aubrey was saying, it depends on where you're at in the company. But typically if you are an insider, you do need to get some special clearance, and it does need to get reported to the SEC that you are selling it. But if you are not if you're not an insider, then you might fall into some of those different blackout periods where, hey, 30 days before the quarter ends, or something along those lines, but it's not reportable.
You know, I asked because during the first PG&E bankruptcy, I was the one giving them the revenue forecast and I had an NDA, and my 401k was great. I was buying very low. I said, okay, this is all right.
And one thing I think that I always tell clients they need to talk to Abraham about is you have to keep in mind that, especially what people who are at companies that are doing very well. So for example, Apple, let's say you work at Apple, you have restricted stock units that are vesting every quarter, and you have, obviously your wages are coming from Apple. And so it's easy to say, well, Apple's just doing great, and so I just have all this stock and I'm just keeping all this Apple stock. But now your whole wealth is tied into Apple. And as a lot of us were around in 2008, 2009, we saw some very big companies disappear overnight. like, that's a really stupid idea. Just even no matter how good the company is, right? So diversification becomes a big issue, and it's hard for people, especially when they love the company they work for and the company's doing great and stock price is going up and they want to just keep holding it. And I just keep saying, but you still, there needs to be a plan, and you can't hold all these RSUs. You really need to be selling some of your stock. So that, and I'm always saying, go talk to your financial planner, because I think you're too heavy in this, and that's not my area. Like I'm really talking to you about taxes, but diversification can become a real issue. I think it kind of like unknowingly, or like in a way that people don't exactly grasp, because you wouldn't go buy that many shares necessarily of Apple, but when they just vest every quarter and show up in your account, and now all of a sudden you have just tons of Apple, you can kind of get yourself into a riskier situation, I think, without, if you're not talking to somebody like Abraham to like look at kind of the whole picture of where's all your wealth.
Yeah, and then just like Aubrey was mentioning in terms of like ISAs and AMT, and there's not like a simple like generic rule of thumb for like concentration of wealth, right? So like you'll often hear like, hey, I shouldn't have more than 10% of my company stock, or I shouldn't have greater than 10% of my company stock inside my portfolio side. For what Aubrey's mentioning, they pay my bills, I work for them, and so yeah, 401ks, like all things, so it all can be tied together over there. But there is no generic rule of thumb. And again, that's like part of my job is to figure out like what is your threshold for it. What are your goals? Like how much do we have? If someone has, $30 million and they have 15 million outside of Apple and 15 million in Apple, and they're hitting all their goals, that is okay to have 50% in that concentrated side, and then we can figure out that other portion over there, right? Again, they have to understand that what that other 15 million is going to zigzag like. However, it's very different if I have $2 million and now 90% is tied to, or 50% is tied to Apple stock over here, and I have other goals that I need to pay for over there. It might not even make sense to have 5% in that side. So again, what the concentration is of your holding in that stock depends more on your goals and what your bigger picture looks like versus just like the generic rule of thumb over there. And sometimes people will want to hold on to it again from like a sentimental, I want to say sentimental, but it's my company. I know it's going to do well, right? And again, that is not always the case. So you look at it, like as Aubrey saying, from like an objective eye, which is hey, if I just gave you $20 million, would you go out and buy Apple stock and nothing else? Would you do that? If you would, then keep doing what you're doing, If you're not, then let's figure out an exit strategy to kind of slowly dwindle that to get that down. Okay, so ESPP or the Employee Stock Purchase Plan over here, I think it is, again, that's a saving on steroids. I think it's a great benefit that's out there. There are different rules that are involved with it, so not every ESPP plan is run the same. I think that's the most important thing to know. But if it is like a traditional one where typically you can buy within a 6-month window period, and then they'll allow you to sell after that. If they allow you to sell immediately, then I feel like it's really good. Some places have restrictions where they don't allow you to sell in that after that 6-month window. So in this instance over here, if I were, all it does is provide me a discount, right? So there's 2 different types of discounts that I can get, but mainly it is, hey, the share price is worth $35 if I were to buy it in the open market. If I were to buy it in the ESPP plan, I would get a 15% discount off of that, $35 in this example. There is a look back provision as well that some plans have, which just simply means like, I was buying these shares from January 1st to June 30th. What was the higher value or what was the lower value? So the lower value is on, let's say June 30th. So I can get a 15% discount off of the lower value of that side. So again, there's the look back provision. So that's what this is showing in here. But nonetheless, there is a 15%. That is typically what most companies offer, is going to be a 15% discount. Again, it doesn't have to be that, but that is what most places do offer. And if I am able to do that, that's when I was saying, hey, that's at least telling you you're going to get a 15% return over here. I don't want to hold on to the stock because you work there, you have other options, you have RSUs that are kind of going on the side. Let's use these and exit out of these and just get that return. Again, it also assumes that I have cash in order to do that during that time period. It also assumes that I have a cash reserve in case like to withstand that short time period of my lockup. But that's essentially the biggest thing with the ESPP, is that it gives you a discount on what that share price is during that 6-month time period. You want to talk about taxes on the ESPP side?
So basically so you get a discount, but you also pay, your spread again is income, right? So they let you buy them at a lower price, but then the delta is income to you. Again, it goes into your W-2. And so then your basis is the value because you've recognized the discount essentially as income already.
So whether you pay $25 a share or $3 a share, the basis is still $35.50.
Right, because you're gonna recognize income for the delta. Yep. So it's just a way for you to essentially kind of cheaply get shares in the company, and they want to incentivize people to believe in what they're doing and own shares.
Yeah, and like I said, the reason I like to sell those right away is that if I sell it, I'm guaranteeing myself that either 15%. Again, factor. I usually say 7.5% or 7% because I'm just assuming that I'm going to get taxed on 50% of that, right? But that is still better than what most savings accounts are paying, which might be like 2% or something like that, right? So that's why I say it's like kind of like savings on steroids. Even after factoring in taxes, it typically will be better than that. Again, assuming that it allows me to sell at that time period. All right, your cheat sheet.
So I just this is just for people to have. This is just kind of like the quickly going through kind of the quick tax treatment of each thing. So again, we've talked about it. So when you get options, whether you get ISOs or non-quals, there's nothing happens at grant, right? You're just getting the option to buy them. So there's no kind of tax treatment, there's no income, there's nothing. On ISOs, for a qualifying disposition, again, meaning that you hold it for the proper amount of time, your spread, which is your exercise price versus the value when you sell, is going to be capital gains. On a disqualifying disposition, that's going to be ordinary income. But spread at exercise is an AMT adjustment and may trigger AMT in the year of exercise. May not. Unknown, unless you run the numbers, exactly. On non-quals, again, the spread is ordinary income, taxed at it, you're going to get basis for the full amount. So essentially, like the value at the time of exercise, you're going to have basis. That's going to be your basis because you're going to have your exercise price plus you're going to recognize a certain amount of income. Oh, I accidentally have my AMT thing in here twice. Yeah, that should not be there. We're going to have to edit that before we publish these. Sorry. I obviously was moving too quickly yesterday. So that spread needs to get that. Ignore that bullet. It will get deleted out. And then subsequent appreciation on the non-quals is, of course, capital gains because you have your basis, and then whatever it appreciates after that is capital gains. Obviously, ideally, with non-quals, because you're going to have basis and you're going to trigger ordinary income no matter what when you exercise, you're going to hold it. Odds are, if you're going to exercise them, you're going to hold them for a year and get yourself long-term capital gains treatment, just because that's a smarter thing to do. And then restricted stock, which we didn't really talk about restricted stock. So again, restricted stock is something that's much, it's not even that common anymore, but it's still out there. And it's more common in a brand new startup. I'm going to grant you some restricted stock, which means it's got a lot of restrictions on it, which is why it's called restricted stock. And you can make what's called an 83B election on this. So with restricted stock, when you're granted the stock, assuming that there's substantial risk to forfeiture, meaning like it's not vested at the time that it's granted, and there's risks on transferability, or there's restrictions on transferability, there's no income unless you make an 83B election. So usually the reason why this is common in a brand new startup, and often especially like people who start like, if you were Mark Zuckerberg and you just started Facebook and you and your Winklevoss twins or whatever their name was just starting, you guys might issue yourselves restricted stock at like a penny a share, right? And generally what you do is then you make an 83B election and you say, okay, so we're going to recognize our penny a share now while this stock is basically worth nothing. And the reason you're going to do that is because if you don't do that, then as it vests, you have to recognize income at the vesting point. And usually what the founders are saying is, we're gonna hurry and make this election now while it's worth nothing. Like, we're gonna say it's worth a penny, and so, you know, I got 100,000 shares at a penny each, whatever, so I've got $1 or $10 or whatever in income. And then instead of, I'm gonna hope this company's gonna do well and it's gonna vest over the next 5 years, and each year when it vests, now it's worth $10, and now it's worth $20, and now it's worth $30, and if I didn't make that election, then every time it vests, what it's worth at that point, I have to recognize income. So that's why you always want to make the election, because usually you make the election because you believe that what it's worth now is going to be much lower than what it's going to be worth when it vests. And then the subsequent sale is again capital gains. So again, these are much more common in like very early startup, and often founders issue themselves restricted stock. That's when you see this more commonly. And then restricted stock units, which we've talked about, there's again no taxable income at grant. When they vest, there's ordinary income at the time that it's delivered. Sometimes restricted stock units are settled in cash instead of in stock, so that's why I said that, but it's more common in Silicon Valley that you get stock. And you cannot make an 83B election on restricted stock units. It's only on restricted stock itself, which is again less common. So those are just kind of my quick kind of cheater items for restricted stock.
115 slides. Grant.
I know grant is misspelled.
Nothing that's not obvious.
I needed to go through those.
Yes, okay.
I'll make those corrections.
I've done that so many times.
And I will claim that both of those are mine. Those are mine. Those are not Abraham's.
Okay, and then I know we're kind of running a little bit tight on time, or because we're wrapping things up over here, but I didn't want to, like, in terms of like looking at it from a financial planning standpoint, again, there's different software tools that we're looking at as we're trying to do projections for people or run scenarios for them. So I just kind of looked at a couple of simple examples. Again, like these conversations that we're talking about right now will usually be like multiple meetings and data, et cetera, as we're figuring it out. But from a high level, really simply what I'm trying to show over here is like sometimes like the E-Trade statement will show like, you know, you're worth $12 million, which is fantastic, and that feels really good. And then you see like, oh wait, I'm not fully vested in everything. It's like my potential value. So what this is showing over here is usually you're given different grants at different dates. So we're identifying each of the different ones, like the grant types, whether it's a non-qual or an ISO. When does it expire? What are my different exercise prices for those, what are called tranches? How much is vested? But really also what I'm trying to show here for like to some of this is an example over here, but over here it's telling me like how much like is this actually worth, right? So I have to pay $2 million in order to get those options. And so therefore like my total in the money value is really $10 million out of those shares. And then there's going to be taxes if I were to sell those right away. So there's taxes roughly about like $4 million if I were to sell right away. So really my after-tax value is like $6 million. Again, we can play with like what the different tax brackets are, what the different prices are, but mainly I don't want to just kind of get married to like my potential value is 12 million over here when I might not be fully vested in that, or I might have to pay for some of the, I'll have to pay for some of those options. And then again, like there's taxes that are involved with it as well. So again, just trying to break down like what do I truly have over here. So again, same thing with like the lottery. You won like $10 million, but not really. Right? They're gonna take some money before that. Just like our paychecks. Like, hey, you make $200,000? Not really. Like I didn't see 200,000 get in my bank account. This over here, I think for options, one of the greatest things about options is the leverage that's involved with it. So kind of like real estate. So like real estate is really great because if I buy $1 million home, I do not really pay $1 million to buy that, right? I usually do like a 20% down payment. Therefore, my internal rate of return is like much greater than if I had just truly bought $1 million. So same thing with the option. As if I paid my option price was at $10 and the fair market value was at 20, I have a little bit of leverage. It is a down payment that essentially I'm making over here. So what this is just showing over here is when the stock is going at different prices, whether it's positive 20% or negative 20%, what is like, how much do I feel that change or that leverage? And I use this for options because like the less leverage there is in options, then the less reason that I want to hold on to that as an option. I may as well just own that stock outright. Again, that's kind of what this is trying to show over here is like, hey, once this is worth $16, I no longer have that much leverage. So at that point, it probably makes a lot of sense to sell it versus owning it as like a regular stock. Where in the beginning part, 20% gain really felt like a 24% gain. So again, just the leverage that's involved with options is a really, really nice thing. I don't think I use the best example over here because my strike price is probably too low. But anyways, but the main thing is that's like what the nice thing is. If like I have a really low strike price and the share price is what that leverage might look like in that side. And then the last part, again, just like a very simple part is the forfeit value. So I'll use this when clients are thinking about leaving their company, right? And as they're trying to like negotiate with other companies, like they are leaving money, like if they stay, they will get X amount more, right? So if RSUs, like if I vest another time, I'm gonna get another $25,000, where I have these incentive stock options that are vested at different time periods. So what this is showing is in terms of like, how much money am I leaving on the table over here? So in this simple example over here, like I'm roughly leaving like $200,000 on the table. So as a bargaining chip, like I don't want to lose that money. Like my job is to help you make more money. So as like a bargaining chip that will either try and use that as like with the new company X that I'm going to, that they're either giving me that same kind of like vesting schedule, or as a signing bonus. I don't want it, or I might just decide, hey, that's a lot of money I'm leaving on the table, therefore I'm going to work there a little bit longer because this trade-off is not good enough over here. But mainly, I don't want to just let it, like, I don't want to leave and then be like, oh shoot, like I forgot about those options, or like I didn't know like that it was worth like $200,000 if I would have just stayed like an extra couple months or whatever the case might be over here. So the forfeit value is essentially what we're trying to use to help clients negotiate different compensation packages or when to go or stay. Again, that's a very simplified one, but just showing that there's different tools out there to look at those different areas. And then, I don't know, kind of to wrap it up over here, when we have equity, I think it's a fantastic thing. Obviously, it's better than not having equity, and so I think it's a good thing to celebrate and enjoy. But at the same time, not kind of like lose our general principles that are around over there. Second part is like, I don't want that terminology, like I was mentioning, to like make me stick my head in the sand. Let's understand what they are, and then let's kind of break it down to small pieces so we can better understand how to maximize it. And then that's what an accountant like Aubrey or financial planner like myself is there to help you with, is to look at what are their different options. How do we maximize this? What are my different scenarios that I can look at? What should I be aware of over here? That's our job, is to help you with that, so you can feel more confident in your decisions, because sometimes they are irreversible decisions in there. So we want to just make sure that we're taking a look at it before executing those. Aubrey, do you want to end?
No, I think I think equity comp can be a huge, a lot of people working in tech, the larger portion of their compensation is equity. It's not their wages. And like we said, some of it you have a lot of choices and things to consider, and some of it just happens the way it happens. You get it or you don't. So it's really understanding what type of equity do you have, and then what choices do you have related to that.
So hopefully it was okay, I put your email address out there. Hopefully, as you can see, Aubrey knows a million things on this topic. It can help with a lot of different scenarios that are out there. So please reach out to her on those different questions. Our next event, like I said, is our Pride Party side, and then after that is our education for children. And then these are our lovely disclosures that are involved in terms of that are out there. So all right, well, thank you everyone for coming in. Thank you.